Hello, and welcome to this session of Money Matters. Today, we are going to talk about insurance. And if you remember from our previous session, the reason we're doing this is to help increase the knowledge of both our employees and our members. So if you're more confident in these topics, you can have a confident conversation with your members and help increase their knowledge as well. So today we're going to be talking about insurance, and there's lots of different kinds of insurance to consider. But before we get started, let's take a little quiz. So for our first question, the purpose of insurance is to minimize the risk of harmful events occurring. True or false? And the answer is false. Insurance exists to minimize the financial cost of harmful events that occur. So obviously we can't stop the events that are occurring in our life, but we can minimize the risk to our financial situation if we have insurance. So question number 2, which of the following is false? An insurance policy is a legal contract. In risk management, you should only buy insurance to cover the amounts at risk. You can save money by buying only benefits and riders you need, or you should always insure your property against loss. The answer is you should always insure your property against loss. You should only insure property for losses you cannot afford. So for instance, if you have a fully funded emergency account, you wouldn't need to buy insurance for small purchases that you could cover if something happens. So think of every time you go to an electronics store, they always want to sell you an extended warranty. So what you have to do is think about the risk of that. If something happened to this item, could I afford to replace it? And if the answer is no, then you might want to purchase insurance in case something happens to it, then you could replace the item. But if you have a fully funded emergency account, you can save a lot of money by avoiding those types of insurance. The second question, disability insurance involves putting a monetary value on a person's ability to earn money. The answer is true. This is exactly how benefits are calculated. It looks to say what is your average earnings and what will we need to pay out. So they're going to base the cost of disability insurance based on the amount that you earn. The next question, which of the following is a way to manage risk? Assume risk, avoid risk, share risk, or all of the above? And the answer is all of the above. Risk is all around us. We can manage it by assuming it, avoiding it, and sharing it, or transferring it to someone else. Transferring it to someone else is exactly what insurance is all about. We're going to transfer that risk to somebody else when we can't afford to cover the loss ourselves. The next question, long-term care is typically covered by health insurance. True or false? And the answer is false. It's typically covered by long-term care insurance, not health insurance. So think if you were disabled, if there's some reason that you have to be in a long-term care facility, your health insurance does not cover that. And we'll talk a little bit about that later on and what your chances are of needing that long-term care insurance. So let's talk about some basic concepts of insurance. So insurance is basically pooling risk of many people. So if we take 100 people and the insurance company insures them, we're all going to pay a premium in, and we're pooling our risk so they can afford to cover that 1 or 2 losses that may occur. So we're kind of sharing in that, if you will. You can only insure something that you have an insurable interest on. So for instance, I could not purchase homeowner's insurance on your home because I don't have an insurable interest because I don't own the home. So you have to have an insurable interest before you can purchase insurance. Some things you want to think about is you really want to evaluate your risk. What are the risks to the assets that you're trying to cover? What's the chances of this breaking or burning or you losing that asset? Can you afford to pay for the loss? And what's the best method to handle the risk? Is it through insurance by transferring it to somebody else? And are there steps that you could take, can you appropriately take to cope with the risk? So sometimes there's things we could do that helps minimize our risk as well. So we want to consider that as well. So some different kinds of insurance that we're going to talk about today is disability insurance, health insurance, long-term care insurance, homeowners insurance, automobile insurance, and life insurance. So let's dig in. The first one is disability insurance. So what is the definition of a disability? So typically it's based on your occupation or trade, and it's your ability to perform any of the duties in your occupation. Sometimes there's a partial disability, and that's when you're unable to perform a majority of your regular occupation. The benefit period, this is the length of time that the disability will be paid. Typically, it's a set number, or it's until you reach the age of 65. So sometimes disability insurance will cover you for 10 years, or it may cover you until 65 when you're eligible for other assistance. The elimination period or waiting period, this is how long you have to be disabled before your benefits begin. So for instance, our disability provided to us as employees of American One has a 7-day elimination period. So the disability insurance start paying on day 8. So in order to get paid for those first 7 days, you would need to use your PTO time to get paid for that. Disability excluded. So some policies may exclude certain kind of illnesses or accidents. For instance, they might not cover if you're skydiving, or they might not cover if you're flying an airplane. So sometimes there's things that are excluded, and you'll want to know what those are if you take part in any of those kind of activities. Guaranteed renewable or non-cancelable. Some policies can be canceled based on changes in your occupation, or non-renewal, or have an age restriction. If you have disability insurance through work, it's typically something that cannot be canceled. But if you're out buying it on your own, you want to make sure that you understand what those clauses are that could be in there. When we think of disability insurance, another thing we always like to talk about is the role of workman's compensation. So if you're disabled and can't work, disability will pay, in our case at American One, 66% of your salary. However, workman's comp is something that if you're injured at work, we always want to file workman's compensation claim first, because that's going to pay 100% of your benefits or your pay if you're injured on the job. So disability insurance is great for if you fall off a ladder and break your leg and you're out of work. If you're off on maternity leave, disability insurance will kick in. But if you're injured on the job, we always file workman's compensation first. It's better for you as an employee because it gives you more income coming in. So let's dig into health insurance. So there's several different kinds of health insurances. And now that we have Affordable Care Act, a lot of these things have changed recently. So some of these terms may be new. So there's a PPO. There's usually an HMO or a high deductible plan that you can choose from if you're choosing your employer's health insurance. So PPO is going to be the most expensive, but it gives you the most freedom. So you can choose your doctor, you can choose your provider, but you're going to pay a little more for that. An HMO is typically going to limit that you have to have a participating doctor to get the best benefit. So your doctor or your hospital needs to participate to get the highest payout. You can still go to a non-participating doctor, but your percentage that they're going to pay of the claim is going to be a little bit lower. So if you have specialists and things like that, you really want to check out the HMO and make sure they're part of the plan in order for you to get the best coverage. And if not, then maybe you want to consider going to the PPO, which you'll pay a little more for premium, but you have a little more flexibility. There's also a high deductible plan. And if you're basically a healthy person and you don't foresee having to go to the doctor a lot, a high deductible plan can be very a good cost saving measure. So if you're in a high deductible plan, it means you have to cover the first X number of dollars, maybe it's $6,000 of expenses, and then insurance starts after that. So you have to be pretty sure that you're not going to need to go a lot, but you save a lot on premium. The other thing that you can do when you have a high deductible plan is you're eligible to contribute to an HSA. So that's a health savings account. That's tax deferred money. There's a lot of benefits to high deductible plans. My husband and I were in a high deductible plan for several years, and it worked out to our advantage because we were paying a lot less in premium. And they still cover all of the basic, your wellness checks and things like that you have to have. So unless you're you know you're going to have a surgery or you're going to have a baby or something like that, it may be worth your while to look into a high deductible plan and put some money in that health savings account from the premiums that you're saving, so that you do have some money saved up to cover that expense. If covering that first amount, whether it's $6,000 or some other amount, is going to be a challenge for you, then you probably want to steer clear from that and look at the HMO. Some other kinds of coverage that may or may not be included in your in your health insurance plan depends on your employer or where you're getting your insurance from. Sometimes it can cover dental expenses, vision care coverage, prescription coverage, and sometimes there's a Medicare supplement or a Medigap policy that may be in there. So for us, in our policy that we have, it does include prescription drug coverage, and there is also vision care, which is through VSP. And then on top of our health insurance, outside of that, we have some self-funded dental coverage and vision coverage to help you pay for your out-of-pocket expense. So you just really want to understand what's in the policy you're buying, and if you need to add anything additional on. Just remember that as with any insurance, the policy elements is what's driving the premiums. So whether you choose a PPO or an HMO or high deductible, that's going to choose your premium. That's going to help drive your premium price. Or if it includes prescription drug coverage or dental or vision, all of those things obviously will add on. So you want to make sure you understand those. Another component of health insurance, if you're employed, is COBRA. And what COBRA does is it stands for Consolidated Omnibus Budget Reconciliation Act of 1985. And this protects you as the employee for an extended period of time after a termination or resignation for up to 18 months. So for 18 months, it allows you to purchase insurance through your previous employer at their cost. And this can be a huge cost savings. So if you were to leave employment at American One and you weren't going to another employer that had insurance, or you weren't able to be picked up on a spouse's plan, you may want to consider continuing your insurance through COBRA. Yes, you have to pay 100% of it now, but it's much cheaper typically than what you would get on the marketplace, depending on what credits you may be eligible for. It's just something to always keep in mind, that you have the ability to get 18 months of healthcare coverage at your cost through your previous employer. And then I mentioned that we recently had some changes with ACA, or the Affordable Care Act. So some specific things that did is it makes sure that nobody can be denied coverage for pre-existing condition. Insurers can't cancel insurance coverage, and there are no annual or lifetime medical exams, so you're automatically covered. And you can go to healthcare.gov to learn more about ACA, but there's a lot of benefits that we are getting because of ACA. There's some other things and costs that went up and things like that, but it really did help protect the insured person, making sure they had the proper insurance. So let's move on and talk about long-term care insurance. So when you think about long-term care, you're thinking about going into a residential facility where you're going to get round-the-clock care. So when you think about it, what % of people turning age 65 can expect to use some form of long-term care in their lives? And you may want to think about your family. How healthy were your parents and your grandparents? And did they age at home, or did they need assistance? But on average, 70% of people turning age 65 at some time in their life is going to need some form of long-term care. So the question becomes, when do I buy long-term care insurance? So one of the things you want to think about is your age. So your premium, again, is based on these factors, but the premium is based on when do you purchase it? How old are you when you purchase insurance? Dave Ramsey, who's a financial guru, he says age 55 to 60 is where you should start thinking about long-term care insurance. If you buy it too early, you're going to be paying that premium for many, many years, which can be very expensive. But if you wait too long, you could have some health issues that may stop you from being insurable. So that's what I mean by health on here, is what is your health? If your health is declining and you think it's going to be an issue, you want to lock in that premium and that benefit before it's an issue and you can't get long-term care insurance. So once you have a heart attack, for instance, or if you have history with high blood pressure, diabetes, things that could really impact your need for long-term care is going to drive your benefits up or your premiums up, or it may make you uninsurable. Some other things you want to look at is what is the monthly benefit of this policy that you're getting. You may have to pay for a private care institution. It could be $5,000 to $6,000 a month that it would cost you to be there. So what is the benefit that this policy is? Some policies have a benefit maximum of like $2,500, and that means you'd have to subsidize and pay the difference. So you want to make sure you understand what is the benefit you're getting each month versus what the cost would be. Sometimes policies have a length of benefit, so they're going to pay this for 10 years or they're going to pay it for 20 years if you need that insurance. So understand what that is. And just like disability insurance, there's an elimination period. So it might not pay the first 60 days or the first 30 days. You may have to pay that and then it kicks in. And then some policies also have inflation protection, because if you're buying this and not going to need it for 10 or 15 years, there's no way to predict what is that monthly cost going to be that you're going to need. So sometimes they'll increase their benefits based on an inflation rate. So you want to understand that. So you want to make sure that, when you're thinking about long-term care insurance, if based on your history or your family's history, this is something you're going to need, you want to make sure that you build that into your budget because it can be quite expensive as well. Let's move on and talk about homeowners insurance. So if you're a homeowner and you purchase homeowner insurance, what you're covering is your dwelling or your main building. Other structures could be covered. So if you have a pole barn or an unattached garage, you would have riders to include those things. It's also going to cover all of the personal property within your home. And then it usually has a clause in there that it will cover your living expenses. So maybe if your house burns down and you need to stay somewhere else for a few months while your house is repaired or rebuilt, there'll be some living expenses that it will pay. Also some liability coverage in case somebody gets hurt on your property. It will also pay medical payments for things that happen on your property in some cases. And one thing you really want to look for is this covering replacement cost or what the value is today? Because while your home may be worth and taxed at $100,000, if you had to rebuild it, it might cost $120,000 to rebuild that. So you want to make sure you understand what exactly is being covered and what your risk is. So the premium factors in this are all of those things we just mentioned. It's also going to include things like how old is your roof? How close are you to a fire department? Things like that would impact the ability to get the fire put out. They'll may require that you have smoke detectors and things like that. So there's often some things in there that you can do to help reduce your premium, or that your premium may be driven based on where you live. So make sure you also read those exclusions. And then this 80% rule, what this is capital improvements in inflation protect the value of your property. And so when the value of your property or your contents goes up or down, 80% means that the insurance company has to at least insure you for 80% of what that value is. So you want to make sure you understand that as well. And then the last one is flood insurance. And a lot of times we don't think about that. And recently we've seen in the news all that flooding that happened in the Midland-Saginaw area. And I'm not sure if that was a flood zone or not, but I am sure that there's a lot of people who did not have flood insurance that now have lost everything. So you really want to understand where your house is there tendency to flood? And then some mortgage companies will require that. If you're in a flood zone, they're going to require you have flood insurance. So make sure you understand that too. And then my little call out here is even if you're not a homeowner, if you're a renter, you need insurance too. So remember that I said you have to have an insurable interest before you can insure something. And a lot of renters mistakenly think that their landlord has them insured. Well, the landlord can insure the building, and it will be insured, the building itself, but they do not have an insurable interest in your personal property, and therefore they can't insure your personal property. So you need to have insurance as a renter to cover the things that are in your apartment or with the building that you're renting. So you want to make sure you contact the insurance agent and check out renter's insurance to cover that if you want to cover that risk. So auto insurance. So let's talk a little bit about this. So auto insurance has recently changed is one thing that I want to mention. So as of July 2nd, I believe it was, there's been some changes that will impact your insurance. So previously, you were charged a premium in case there were any medical expenses to you if you had an accident that they would cover medical expenses. But you probably already have homeowners insurance too. And so what happened is you end up being double covered and you're paying two premiums, but only one person is paying that bill. So the new auto reform that was just passed allows you to opt out of medical insurance on your auto insurance policy if you have a qualified medical plan. Our medical plan at American One is a qualified plan, so you can opt out of that. The other piece of that is they did increase the defaults for personal injury protection. So this is if somebody is injured in your car, their ability to sue you and get payments. So they did increase the default for that. So you're going to want to talk to your auto insurance agent about those changes. You want to understand what they are and make decisions that's best for you in your situation. So when you're thinking of auto insurance, it talks about liability insurance. We're covering personal protection, although this medical now, if you're opting out, will be covered by your medical insurance. It also includes if you're in an accident and another car is there with uninsured or underinsured motorist protection, you can get collision insurance or comprehensive insurance. You can also get towing and roadside car rental. All of these things are premium factors that you need to think about and what's driving the cost and what's important to you. You can reduce your premiums when you start looking at deductibles. So do you have a $50 deductible, a $100 deductible? If you want to save money and you have a fully funded emergency fund, maybe you jump up to a $500 deductible or even a $1,000 deductible. And you can do that same thing on your homeowner's insurance, is look at what your premium or what your deductible is and increase that deductible will reduce your premium. And especially on homeowners insurance, there's a lot less risk in homeowners insurance in increasing that. You're probably not going to have a claim that you have to pay out, but you want to understand that risk for you. Living in Michigan, we have a lot of deer accidents. You know that's going to happen, so you want to make sure that you have a low deductible because it's likely that's going to happen. So the 100, 350 that I have here, there's always three numbers on your insurance policy. The first one has to do with bodily injury liability per person. So each person that's in your car, if there's a car accident, it's going to cover, in this example, up to $100,000 of expenses. The 300 is the total bodily injury for the accident. So if you had 4 people in your car, they're not going to pay $100 for each one. It's going to be 300 divided by 4 would be the max that they would pay. And then the property damage in this example is $50,000. So if there was any property damage due to an accident, it would pay that up to $50,000. And again, those numbers can be anything that is important for you and your situation and your risk. So you'll want to check that out with your agent as well. Let's move on to life insurance. So the question is always, who needs life insurance? So remember that the purpose of life insurance, it's not an investment. Life insurance is to replace lost income. So the people that need life insurance are anybody who earns wages that contribute income to your household. So that could be a husband and a wife, it could be just one, but you want to replace that earnings. The second thing that you want to think about is even a homemaker who doesn't have an income, you want to have insurance to cover if something was to happen to that person, you're going to need to cover the expenses to care for the kids, to raise the kids, for housekeeping, things like that. So you want to make sure that you have life insurance on even somebody who doesn't work so you can cover any extra expenses you may incur without them in your household. And then the third kind of person would be anybody who has debt. So if you have a mortgage or auto, things like that, you have this debt, even if you don't have income, you could be retired, you would want to make sure you have enough insurance to cover that debt, because otherwise it's going to come out of your estate. And you want, typically, if you're in that situation, you plan on leaving money to your kids, whatever. But if you have debt, you can get insurance on that debt so that it would be paid off if something happened to you. So there's several kinds of life insurance to think about. So term life is a level term, meaning going into the policy, you know that this is going to last for 10 years or 20 years, or for the life of this loan, if you get decreasing mortgage term insurance, for instance. So you may start out with decreasing term, meaning it started out for 30 years, but each year you pay off your mortgage, the term is going to decrease. And that used to be very popular. I'm not sure many people use it that way now, but you can still get increasing term policy. When you hear the term whole life, or sometimes it's also called universal or variable, that really combines a life insurance policy with an investment. So it's purchasing some term life insurance and then investing the rest. And a lot of people are comfortable doing this because it's easy and you don't have to think about it. But if you're good at investing, and I know we're going to get to investments in a future lesson, but if you are confident in what you're doing, it is much more economical to buy term insurance and buy your life insurance that way, and then take your extra money and invest it yourself. You'll have better control of it and pay less fees. So I would caution you when you're thinking about whole life, is this really the best decision for you, or can you do it separately and do it less expensive? So how do you determine the right amount of coverage? There's all kinds of things online that will tell you, you can put in numbers and try to figure that out. Sometimes they say 10 years worth of income you want to replace. It just really depends on your situation, and it depends on what the intent of that policy is for. If you're close to retirement and you're debt free and you don't have a mortgage or anything to pay off, then there's really no income to replace, no debt to pay off. You probably don't need as much life insurance unless you're using it to leave money for somebody else. In investing world, we often use the term, is this money to live on or leave on? So if you want to leave money to other people, sometimes people use life insurance for that. If you're a young person, and you have a large mortgage and you have debt and you have small kids in the home, it's extremely important that you have enough life insurance to make sure that your family can continue on in the lifestyle that they have. So go online, there's a lot of calculators you can plug things in, talk to the agent, but most importantly, you need to understand your purpose for getting life insurance, and how much you need is based on what your needs are. So let's talk about 7 rules for better insurance decisions. So number 1, no matter what kind of insurance we're talking about, these all apply. So you need to determine your insurance needs. Why are you purchasing insurance? Make sure that you're purchasing the kind and the amount that meets your needs, not what somebody else is telling you you need. Make sure you shop around and compare prices. It's just like anything else. Insurance prices can vary differently. They advise on auto insurance, you should at least shop your policy every 2 years, because rates go up, claims come in, and every different insurance agency will have different rates. So make sure you shop that frequently. Make certain the premium and the deductible fits in your budget. So if you pick all of this insurance and you can't afford the premium, it's often cause your insurance poor. You have so much insurance in case something happens, but you can't afford to meet your budget needs today. And that's not a good place to be in. You want to make sure your deductible is appropriate for you. So depending on what your emergency fund is, that's going to tell you how big your deductible needs to be. And remember, never risk more than you can afford to lose. So if you have an item that's not insured and you lose it, what would happen? So you really want to think about, do you want to transfer that risk of loss to an insurance company and pay the premiums? You also want to know the odds of suffering a loss. It's much more likely you're going to hit a deer, as I mentioned, than your house will burn down. So what are the odds of something happen? And if there's ever a problem with your insurance or your claims or anything like that, make sure that you're reporting them to the state insurance commissioner. There's an agency there to help you do that. So the last thing I want to mention is CUNA, who is our 401k provider. They have a lot of online resources for insurance. And you can start out by taking a quiz, but then there's videos and different topics and things that you can ask for. So if you go to benefitsforyou.com and log in, if you need help with that, log on. Your HR team would be more than willing to help you with that. But there's a knowledge base on there that's fabulous. It's got great information. They're insurance experts, and that will be able to answer a lot of your questions as well. So we're going to wrap up by looking at our 10 steps to navigate financial success. And these are the ones we've been talking about. If you're really serious about getting out of debt, stop adding more debt, know where you're at, what's your income, what are you spending, make sure you create that budget every month. It'll take 2 or 3 months to get it under your belt, but then after that, usually it's very easy. Make sure that you've started that emergency fund. And I mentioned this last month, after COVID, most people think starting with $1,000 is not enough. They learned that in this crisis. So as much as you can get in your emergency fund is a good idea, and then work on paying off your debts, except for your mortgage. smallest to largest. And you'll be on the first half, and we'll get to the second half of this 10 in future sessions when we start talking about investments. So if you have any questions, feel free to send me an email, send me a message. And remember, this is just information for you. You need to contact your insurance agent specifically for specifics. I am not a licensed insurance agent, just here to help you ask the right questions. So have a great day. It was great to talk to you today.